This conversation is powered by Google Illuminate. Check out illuminate.google.com for more. Welcome to this discussion on a fascinating piece of financial history, Section 27 of the Federal Reserve Act, specifically focusing on the tax on national banknotes. It's a topic that might seem obscure, but it reveals a lot about the early development of our monetary system.
Indeed. This section, while seemingly small, offers a window into the complexities of regulating currency issuance and the delicate balance between private banks and the federal government in the early 20th century.
Exactly. It's not just about taxes, it's about control. The government's ability to influence the money supply through taxation is a key element.
Precisely. The tax mechanism was a powerful tool for managing the amount of currency in circulation, influencing inflation, and ensuring the stability of the banking system.
And the evolution of this tax itself tells a story, doesn't it? Let's dive into the details. The text mentions national currency associations and amendments to the National Bank Act. Can you elaborate on their significance in the context of this tax?
National currency associations were essentially a precursor to the Federal Reserve System. They allowed national banks to issue their own banknotes, backed by various securities, not just U.S. government bonds. The amendments, particularly the extension of their authorization, reflect the ongoing experimentation with monetary policy in the early 1900s.
So this wasn't a completely centralized system from the start?
Not at all. The initial system allowed for a degree of private banknote issuance, which led to inconsistencies and potential instability. The tax on these notes was a way to manage this decentralized system.
The document details a tiered tax system on national banknotes not secured by U.S. bonds, starting at 3% and increasing to 6%. What was the rationale behind this graduated tax structure?
The graduated tax was designed to incentivize banks to rely more heavily on U.S. government bonds as backing for their notes. The higher the tax, the more expensive it became to issue notes backed by other securities, making government bonds a more attractive option. This promoted stability and reduced the risk of uncontrolled currency expansion.
It's a fascinating example of using taxation as a regulatory tool, not just for revenue generation.
Absolutely. It was a subtle but effective way to steer the banking system towards a more stable and controlled currency supply.
The text also grants the Secretary of the Treasury significant discretion to suspend certain limitations on note issuance. What was the purpose of this provision?
This flexibility was crucial during times of economic uncertainty. The Secretary could temporarily relax restrictions to increase the money supply if needed, for example, during a financial crisis or recession. This allowed for a more responsive monetary policy.
So it was a built-in safety valve of sorts?
Precisely. A mechanism to address unexpected economic shocks and prevent a complete collapse of the banking system.
The document mentions extending the benefits of this act to qualified state banks and trust companies. What does this tell us about the broader goals of the legislation?
This demonstrates a move towards greater integration and standardization within the banking system. By including state banks, the government aimed to bring more institutions under its regulatory umbrella, further stabilizing the financial landscape.
A step towards a more unified national banking system. The document notes that certain sections are omitted from the U.S. Code. What does this omission signify?
The omission indicates that those sections were either repealed, superseded by later legislation, or deemed obsolete. It highlights the dynamic nature of financial regulation and the continuous evolution of the monetary system. These omissions are not necessarily insignificant. They reflect changes in policy and priorities over time.
The last update is from February 14th, 2017. Does this section of the Federal Reserve Act still hold any relevance today?
While the specific mechanisms described are largely outdated, the underlying principles remain relevant. The idea of using taxation to influence the money supply, the need for flexibility in monetary policy during crises, and the importance of a stable and well-regulated banking system are all enduring concepts in modern finance. The historical context provides valuable lessons for understanding current monetary policy debates.
Looking at the broader context of the Federal Reserve Act, how does Section 27 fit into the overall scheme of things?
Section 27 is a small but important piece of a much larger puzzle. The Federal Reserve Act was a landmark piece of legislation that fundamentally reshaped the American financial system. Section 27, with its focus on the tax on national bank notes, reflects the Act's broader goals of creating a more stable, flexible, and centrally managed monetary system. It's a microcosm of the larger effort to regulate and control the nation's currency.
The section highlights an interesting interplay between private interests, national banks, and public interests, the government's need for monetary control. Can you elaborate on this dynamic?
The tension between private banking interests and the public good is a recurring theme in financial history. Section 27 exemplifies this tension. National banks sought to profit from note issuance, while the government aimed to maintain stability and prevent excessive currency expansion. The tax mechanism was a tool to balance these competing interests.
What lessons can modern monetary policymakers learn from the historical context of Section 27?
Several key lessons emerge. First, the importance of carefully designed regulatory tools to manage the money supply and maintain financial stability. Second, the need for flexibility in monetary policy to respond to economic shocks. Third, the ongoing tension between private sector interests and the public good in the financial system. Understanding this historical context can inform current debates about monetary policy and financial regulation.
How has the approach to managing the money supply evolved since the time of this section of the Federal Reserve Act?
The tools have changed dramatically. While taxes on banknotes were once a key mechanism, modern monetary policy relies on a broader range of instruments, including interest rate targeting, open market operations, and reserve requirements. However, the fundamental goal remains the same: to maintain price stability and support economic growth. The evolution reflects advancements in economic understanding and the development of more sophisticated policy tools.
Despite the changes in specific tools, what enduring principles from Section 27 remain relevant today?
The core principles of maintaining a stable and well-regulated banking system, using regulatory tools to influence the money supply, and balancing private interests with the public good remain highly relevant. These principles continue to guide modern monetary policy and financial regulation. The historical context provides valuable insights into the challenges and complexities of managing a modern economy.
So while the specific tax on national banknotes is a relic of the past, the underlying principles and the lessons learned from its implementation continue to shape modern monetary policy.
Precisely. The historical context offers valuable insights into the ongoing challenges of balancing private interests with the public good in the financial system.
That was a great discussion. Thank you for your insights.